Swayam Prabha. Digital India. Educated India.
Welcome to the next session on commodity derivatives and risk management. Today we are going to discuss what is commodity basis risk, but before we go to what is the definition of basis and how basis affects the commodity or risk associated with commodity futures investment, let's spend a little more time understanding what we discussed last session. If you recall, in the last session we discussed about contango, about backwardation. We also discussed about the cost of carry model, and if the cost of carry model does not hold true, how the traders will be able to take cash and carry and reverse cash and carry arbitrage to get benefit. So just to summarize what we discussed in the last session. Remember, we discussed how this arbitrage model or cost of carry model with no arbitrage assumption holds true for pricing forward or futures contract for financial assets, for investment commodities such as gold and silver, and also consumption commodities like copper, almond, jeera, or steel, tin, and this consumption commodities without any supply constraint. So any consumption commodity which does not have a supply constraint at a given point of time, that can be valued using your cost of carry model with no arbitrage assumption. However, whenever a commodity is facing a supply constraint, or at that point of time not enough of inventory is available in the market, then cost of carry model does not hold true. Even if the reverse cost cash and carry arbitrage is possible, many traders would not be interested in exploiting this arbitrage opportunity to make profit. Let's take an example. Let's say just before the harvest period, a agricultural commodity price is ruling very high. If you are keeping track of commodity prices of late, you must have read that tomato prices at this point of time is ruling around 80 rupees a kg. So if somebody, let's say tomato pulp futures contract is available for trading, had it been available for trading in Indian context, of course it's not available. So had this tomato pulp futures contract is available for trading, so if a trader would like to price this futures contract at the prevailing spot price, it would take into consideration S0 as 80 rupees and accordingly price the futures contract. However, traders also know maybe within a month or two new arrival tomato will be arrived in the market, and at that point of time spot price is not going to be that high. So considering all this factor, you can have situation when the F theoretical, that is future price calculated based on high spot price today, is substantially higher than the F actual. So that gives rise to a situation called that gives rise to arbitrage opportunity, which is known as your reverse cash and carry arbitrage. However, nobody will be interested to undertake the arbitrage, because the party which is holding the commodity, that party is going to get some benefit from holding that commodity. So that is all known as your convenience yield, as we discussed in the previous class. Now let's go to the, as I discussed, when an inventory of a particular commodity is low and demand for that commodity is higher than the supply, commercial users of the commodity prefer holding the physical commodity rather than holding the forward or futures contract. And this intangible benefit of holding the asset is known as a convenience yield. And in case of in such a situation, you can have a theoretical future price which is greater than the actual future price prevailing in the market, and this situation is, this kind of a market is known as a backwardation market. And as we can see from the slide, that is F0T, futures price or forward price prevailing today for a maturity of T is less than the theoretical price as calculated by cost of carry model. Now we also know, we have also discussed that low availability of the underlying commodity is associated with higher convenience yield and vice versa. Now how do we go ahead and calculate the convenience yield? As I mentioned in the previous class, convenience yield is not visible anywhere. Nobody it's not reported like a nominal interest rate or inflation rate. This convenience yield has to be calculated. So when we equate the theoretical futures price with the actual future price and adjust the theoretical futures price with Y, what we get is your the convenience yield. As you can see from this equation, F0T is equal to S0 into e to the power r plus u minus y into t. So when we solve for this equation, what we can get an indication of what is going to be the convenience yield. That is, what is the value of the physical holding, what kind of a value is being derived by the holders of the asset by holding the asset. Now I have given an exercise you can solve at your spare time. So you have a spot price given, you have a futures price which is the actual futures price prevailing in the market, that is F actual is given, and you have the storage cost is also given, and you have also the continuously compounded interest rate is given. From here you will be able to find out what is the convenience yield. Now let's go to, we have also in the last class we have also discussed little bit on contango and backwardation, and as you know, in case of a contango, the future price will be greater than the spot price, and a distance delivery future price will be greater than the less distant delivery future price. Like price of M2 contract will be higher than the price of M1 contract, and price of M1 contract will be higher than the spot price. Similarly, backwardation, the reverse is going happens, where you have spot being higher than the futures price, and a higher distant delivery future price is lesser than the less distant future price, that is M1 is greater than M2 and S is greater than M1. Now before we go to the basis part, I would like to pose a question. What happens to the spot and futures price on the contract delivery date or the contract maturity date? The answer to this particular question is that both spot and futures price must converge. If convergence does not happen, it will give rise to arbitrage opportunity. Let's take an example, simple example. Let's say, suppose we have a contract whose maturity period is 3 days. So what will be the forward price or future price? It will be S0 into e to the power r into 3 by 365, when r is a continuously compounded annual interest rate. Let's say in place of 3 days, let's make it 2 days. So what happens to your F0t? F0t will be S0 into e to the power r into 2 by 365. And on the contract maturity date, what happens to the value? F0t will be, so on the 0th day, contract maturity day, so S0 into e to the power r into 0 by 365. So anything multiplied by, anything to the power 0. So you will have F0t. In fact, this becomes F00 will be equal to S0. So on the contract maturity date, spot and futures price must converge. So now let's see practically does it happen in real life. I have downloaded certain spot and futures price data from National Multi Commodity Exchange, and let's see whether spot and future price converges or not. So I am opening a link. I want all of you to focus a little bit. So this particular table shows the black paper May 2016 contract data, and this data I have downloaded from NMC data, so National Multi Commodity Exchange, as you can see this link. And let's focus on this data, that is the futures price, futures close price, and also focus on the spot price. So I have plotted this. Now please see this one. In this particular figure shows the this is the contract maturity period, how the spot and future price has moved from let's say this contract matured on, this particular contract matured on 3rd May 2016. So during this period of time, if you see here the futures close price is here and the spot price is here. So this particular position in the graph indicates that the spot price is lesser than the futures price, indicating a contango market. And after some point of time, the spot price has gone, is more than the futures price. This portion indicates the backwardation market. However, if you see this difference between spot and futures price slowly narrows down and it almost converges on the contract maturity. If we go to the actual data, let's say, if you see this one, the futures price is closed at 7300 and the spot price is close to 72500. There is a price difference of 500 rupees. I have to see what is a contract specification for black paper. Probably it will be 100 kg or so. So there is a price difference of 500 rupees for 100 kg. So this, and why still, why exactly it has not converged? As you recall, your futures market have mark to market margin. Futures market are also governed by the daily price limit, but the spot market is not governed by the daily price limit. So this could be the reason why you have 500 rupees difference. Also, one thing I would like to tell here is that this 500 rupees is not commensurate for doing a arbitrage. Had it been commensurate enough, then some trader must have taken the benefit of arbitrage. Recall we discussed also last class, the price difference has to be substantially higher for a trader to buy and sell in both market and factor in the borrowing rate and lending rate. So all these things taken into consideration, probably 500 rupees is not commensurate enough for taking an arbitrage benefit. Now let's go to another contract. This contract is the spot futures for isabgol seed, and I'm sure all of you know how what is a isabgol seed. It is a diuretic, and it is used in many Ayurvedic medicines. So you have spot futures price relationship. So this is sometimes this particular this is very close, the spot futures price is very close to each other, and some point of time it is both prices are exhibiting contango or backwardation market. Another interesting combination, this is the spot futures price between spot futures relationship between the raw jute, for raw jute, and if you can see, the spot is always lesser than the futures price, indicating that this particular commodity has remained as a contango market throughout the life of this contract, that is May 2016 contract. However, again coming back to the closing price is 11,000, futures closing price is 11,096.5, and the spot closing is 11,400. The same logic what I explained for black paper is applicable here. So even if there seems to be a almost 204 rupees price difference, but this is not commensurate enough for traders to take arbitrage. So after this discussion, what we are concluding is that on the contract maturity date, spot and futures price converge. Even if there is some minor differences are there, but for all practical purpose, we can say that the spot and futures price is, spot futures price converges on the contract maturity date. If convergence does not happen, it will lead to an arbitrage benefit. Let me give a very simple example how arbitrage benefit can happen. Let's take. So let's say on suppose on the morning trading time of the futures contract maturity, a contract is trading at, let us say, rupees 700, and on the at the same time the spot price is, let us say, 900. If spot price is, so futures contract on the contract maturity date in the morning, suppose the exchange opened at 10 o'clock in the morning, and around that time the contract delivery for the same contract maturing on the same day is quoting at rupees 700, and the spot price is rupees 900. So how a trader can make arbitrage benefit? As you know, the trader can, arbitrage benefit is can be done only by buy low and sell high. So what he can do, he'll take a long futures contract, take long futures contract at 700 rupees, simultaneously sell the commodities in the spot market, So he will receive 900 rupees from the spot market by selling the commodity in the spot market. He will pay 700 rupees by end of the day. By end of the day, he will be spending 700 rupees, and within the delivery period, he will have the underlying commodity. So making a net profit of 200 rupees from this price difference. Similarly, vice versa, suppose the futures contract is trading at 700, but the spot price is trading at, let's say, 500. And so what the trader can do short futures and simultaneously take a long position in the underlying asset market. So it's a very, very important understanding that what we are discussing at this point is that spot and futures price must converge, and most of the time spot and futures price converges on the contract maturity, otherwise it will lead to a arbitrage benefit. With this, let's start our discussion on what is a commodity basis. When I am saying basis, it is BASIS. It is spelled as BASIS. And if you recall, in some earlier sessions we had discussed that in case of a forward contracts, there are significant amount of counterparty risk. However, in case of a futures contract, there is no counterparty risk. In lieu of counterparty risk, what futures trader face is the basis risk. So what is this basis risk and how it manifests itself, we will be discussing in detail. But before that, let's understand what do we mean by basis. So basis is defined as the difference between the spot price and the future price. So this is how we define. If you see the screen, that is basis on day T, on any day, basis on day T, that is BT, is defined as spot price minus the futures price. And as you know, in case of a contango market, futures price is more than the spot price. So going by that logic, you will have a negative basis in a contango market and a positive basis in the backwardation market. And basis also normally goes down as the delivery approaches, and as spot and futures price converge towards each other, the difference, the basis narrows down and it comes to zero on the contract, almost zero on the contract maturity date. So this is a definition of basis. Now let's understand how this basis poses a risk to the commodity futures holder. So what is the basis risk? Basis risk is the risk that arises from hedging a contract that does not expire on the same date as the underlying exposure. See, if you recall or if you know, futures contracts are standardized, and any day as a consumer of a commodity or a producer of commodity, my physical operation would require me to take delivery or make delivery on a specific date. However, futures contract may not mature on the same date. So this is one of the important reasons why basis risk arises. Let me again repeat, the basis risk arises from hedging with a contract that does not expire on the same date as the underlying exposure. let's again revisit what we have discussed about our understanding on hedging. So who is a short hedger? Short hedger is a party who is long on asset or owns the asset and is fearing that the price is going to go up, the price is going to go down in future. So it is interested to mitigate that price risk by entering into a futures contract for selling at a later date. So long asset party which is owning the asset, he has a fear of price going down and he mitigates that risk by entering into a short futures position, and that's why he is known as a short hedger. Vice versa, a party who is going to buy the underlying at a later date and is fearing that the price is going to go up unless he or she does something, that party will be mitigating the risk. That party will be mitigating the risk by entering into a long futures contract. Now, let's say, let's take an example. Let's say a soya oil producer who is crushing soya bean and produces refined soya oil, and as per its business requirement, it intends to sell the first lot of soya oil it will be crushing on 10th June 2016. So it fears that by 10th June 2016 soya oil price is going to go down, hence on the spot date. So standing on 22nd April, the soya oil producer is forming a price expectation regarding the future price, and he is getting an indication, or he is feeling that soya oil price may go down, and he would like to mitigate that risk by entering into a futures contract. Which futures contract it will take? Let's say futures contract which is maturing on June, that is M2 futures contract, maturity date is 20th June. And if suppose the soya oil producer instead of going to a futures instead of buying a futures contract, or instead of entering into a short futures contract, he could have hedged this risk by entering into a forward contract. Let's assume that both forward contract and futures contract are available at 870. So if this soya oil producer would have gone for futures forward contract, he would have definitely sold the underlying at 870 rupees on the 10th June 2016, irrespective of the prevailing spot price at that date. So by entering into a forward contract, the short hedger, the soya oil producer would be sure of getting 870 rupees. Of course, we are ignoring the counterparty risk, that is that the forward contract, the counterparty, we are assuming that the counterparty is going to abide by his side of the contract. So if the producer would have gone for a forward contract, he would have been sure to get 870. Now instead of going for a forward contract, let's say the producer chooses to go into the futures contract. Now how the relationship between the spot price and the prevailing future price is going to impact its profitability, that we are going to discuss in our next session in detail. So let me summarize what we discussed in this session. We discussed a little bit on our understanding of what is a contango market, what is a backwardation market, and also we spent some time on understanding how the spot and futures price must converge, or why it must converge on the contract maturity date. And we have just started with our understanding on basis risk. So I will be meeting you in the next session with more detail on basis risk. Thank you all of you.